Good morning. Today we are going to discuss about a new topic which is one of the very interesting, current and very favorite topic, that is money, banking and central banking. In this chapter we are going to learn 5 important aspects of the chapter. We have 5 learning objectives. First, we'll define the functions of money, identify the key properties that money possesses, and explain the official definitions of money supply. Second, understand why the financial intermediaries such as banks exist. Third, describe the basic structure and function of the Federal Reserve System. Fourth, determine the maximum potential extent that money supply will change following a Federal Reserve monetary policy action. Fifth, explain the essential features of the Federal Deposit Insurance. The fifth learning objective is to explain the essential features of the Federal Deposit Insurance. Fractional reserve banking enables the Federal Reserve to use the open market purchase or sale of the US government bonds to generate an expansion or contraction of deposits, as we have discussed in the open market operations. Any change in the money supply is the multiple of open market purchase or sale. Another effect of the fractional reserve banking is to make depository institution somewhat fragile. After all the institutions have a fraction of reserve on hand to honor their depositors' request for withdrawal. If many depositors simultaneously run to their bank to withdraw all of their transactions and time deposits, then that concept is called as bank run. If that happens, bank would not be able to satisfy their request, and this would result in the failure of that depository institution. Widespread bank runs can lead to many failure of many institutions. So bank run is an attempt by many banks depositors to convert the transaction and time deposits into currency out of fear that the bank's liabilities may exceed its assets. In 1933, at the height of these bank failures, the Federal Deposit Insurance Corporation was founded to ensure the funds of the depositors and remove the reason for ruinous run-off on banks. In 1934, the Federal Deposit Insurance was extended to deposits in savings and loan associations and mutual fund banks. In 1971, it was offered for deposits in credit unions. You must have remembered the Great Depression of 1930. There was nearly 3,000 failures each year. Have a look at this figure that shows the bank failures in different years. As you can see, bank failure rates dropped dramatically after the passage of early federal legislation. The long period from 1935 until 1990s was relatively quiet. From the World War II to 1984, fewer than 9 banks failed per year. From 1995 until 2008, failures again averaged about 9 per year. Since 2009, however, more than 400 banks have failed and many more are still in danger of failing. We need to understand how the deposit insurance works. The FDIC charges premium to depository institutions based on their total deposits. These premiums go into funds that reimburse the depositors in the event of bank failures. This bolsters the depositor trust in the system and gives them incentive to leave their deposits in the bank, even in the face of the talk of bank failures. Until 1990s, all the insured depository institutions paid the same fee for coverage regardless of how risky the assets were. Banks had an incentive to invest in more assets of higher risk and higher yield. The FDIC and other federal agencies possess regulatory powers to offset the temptation to take risk. Higher capital requirements were imposed in the early 1990s and adjusted in 2000. Now we'll be discussing about the deposit insurance, adverse selection, and moral hazard. As a deposit insurer, the FDIC effectively acts as a government-run insurance company. This means that the FDIC operation expose the federal government to same kind of asymmetric information problems that other financial intermediaries face. Let us discuss about the adverse selection in deposit insurance. One of the major challenge or major problem is adverse selection. Is often a problem when the insurance is involved because of the people or firms that are relatively poor risk are sometimes able to disguise the fact from the insurer. It is instructive to examine the way this works with the deposit insurance provided by the FDIC. The deposit insurance shields the depositors from potential adverse effects of risky decisions. So depositors are willing to accept riskier investment strategies by the bank. And clearly, the protection of depositor from those risks encourages for more high and risk-loving entrepreneurs to become the managers of the bank. Because the depositor have so little incentive to monitor the activities of insured banks, it is also likely that the insurance actually encourages the outright crooks to enter into the industry. And the consequence for the FDIC and the taxpayer are larger losses. The second one is that moral hazard. Moral hazard is also important phenomenon in the presence of insurance contracts such as deposit insurance, which is provided by the FDIC. Insured depositors know that they will not suffer if the bank fails. Hence, they have little incentive to monitor their bank's investment activities or to punish their banks by withdrawing their funds if bank assumes too much risk. And what does it mean? It means that the insured banks have incentives to take on more risk that they otherwise would. Now I have a question. Can deposit insurance be reformed? Since 2005, Congress has sought to reform the federal deposit insurance, and these efforts are still underway. A reform effort that came too late was the Federal Deposit Insurance Reform Act of 2005. On one hand, this legislation expanded the deposit insurance coverage and potentially added to the system's moral hazard problems. It increased the deposit insurance coverage for the individual retirement accounts, or we can say IRAs, which are offered by the depository institutions from $100,000 to $250,000, and authorized the FDIC to periodically adjust the insurance limit on all deposits to reflect inflation. On the other hand, the Act provided the FDIC with improved tools for addressing the moral hazard risk. The law changed a rule that had prevented the FDIC from charging the deposit insurance premiums if total insurance funds exceeded 1.25% of the insured deposits. And this limit had enabled practically all the US depository institutions to avoid paying deposit insurance premium for about a decade. Now, the FDIC can adjust the deposit insurance premium at any time. There was a new structural reform which began since the banking troubles of late 2000s. During the banking trouble of late 2000s, Congress sought to increase the public confidence in the depository institutions by extending the coverage to virtually all the liabilities in the banking system. Although this move successfully, built up trust in the banks, it also expanded the scope of deposit insurance. To reflect this fact, in late 2010, the FDIC altered the structure of the deposit insurance premiums. The FDIC now assesses the premium rates on banks' total liabilities, that is, the bank's deposits plus the borrowing from other sources. The FDIC also raised its premium rates because the base for assessing the premiums and the premium rates are both higher. The FDIC is now collecting premiums and adding to its reserve funds at faster pace. Nevertheless, most economists agree that on net, the FDIC's exposure to moral hazard risk has increased considerably in recent years. In Europe, some borrowers receive interest payments on their loans. There is a concept called as Euribor, and it is an acronym for European Interbank Offer Rate. It means it is an average interest rate on European interbank loans. So, we can say that it is the average interest rate at which a selection of banks provide one another with the short-term loans in euros. Typically, banks in the European countries such as Portugal charge the Euribor plus the intermediation fee for the mortgage loans. Recently, it became negative, and it means that the interest on mortgage also turned negative. So if I ask you, what does this negative Euribor indicate? It means that the interest rate is negative. So instead of paying interest to borrow money, you are being paid money to borrow someone else's money. So it's kind of backward from what we consider normal. But remember, it's not free money. Why the US taxpayers are the last resort funders of much of the financial industry. The US government guarantees taxpayer support in two forms: explicit guarantees and implicit commitments. Explicit guarantees are the legally binding promises that the US Treasury will provide funds to back up the financial institution's liabilities if it fails to do so. Implicit commitments are non-legally binding guarantees, but virtually everyone anticipates the government would honor in the event of a crisis. The passage of the Dodd-Frank Wall Street reform and the Consumer Protection Act has led to expansion of both of these government guarantees. Thank you for all of your kind participation. If you have any questions, feel free to ask me via Zoom, or you can write your questions on the Google Doc that I have shared with you.